While the trade war is the main cloud over economic growth and demand predictions, market participants also pointed to weakening U.S. data and overfull U.S. crude stockpiles. Again, we're seeing the effect of worries about the trade issue on demand, said Jean McGillian, vice president at Tradition Energy in Stamford, Connecticut. Funds and money managers who had built up long positions are heading to the exits as trade concerns dim the demand outlook, he said. Brent crude futures, the international benchmark, settled down or 4.6%, at $1 a barrel. U.S. West Texas Intermediate, WTI, crude futures dropped or 5.7%, to $1 a barrel. Earlier, the contract touched $1 a barrel, the lowest since March 13. That was a second consecutive daily decline for the benchmarks. WTI fell 2.5% on Wednesday after government data showed U.S. crude inventories rose last week, hitting their highest level since July 2017. The survey showed broad weakness, with a measure of new orders received by factories dropping for the first time since August 2009. The firm's survey for Eurozone business growth accelerated less than expected this month. Additionally, tensions are decreasing, some analysts said. The oil market has built-in risk premium related to U.S. sanctions on Iran, and that risk is now seen decreasing, he said. Countering these bearish factors are ongoing supply cuts led by the Organization of the Petroleum Exporting Countries, OPEC. French bank BNP Paribas said high inventories meant that OPEC would likely keep its voluntary supply cuts in place beyond their end June deadline. Global geopolitical risk was still sufficient to provide a floor for oil prices, said against Kilduff. Drone attacks on Saudi Arabia earlier this week called attention to ongoing Middle East turmoil that may prevent oil prices from pulling back to February lows, Kilduff said.